Let's be real. Investing can feel like stepping into a jungle with no map, no guide, and no sense of direction at all. But here's the thing. The biggest threats are not out in the jungle. They're right here in the mistakes we make, the ones that slowly drain our wealth and leave us shaking our heads in the middle of the night with this question: what did I just do? We're talking about the mistakes that can derail your financial journey faster than how long Jim lasted with Nadia in the first American Pie movie. Okay, maybe I'm over exaggerating a little bit, and I bet you didn't see that joke coming. But anyway, these are not just theories, they're real life mistakes that I've seen, made, and learned. Mistake number one is you lose patience or become fearful of the market volatility, and you end up exiting the market too soon. Now, picture this: it's March 2020. The world was full of uncertainty. Markets are crashing, the news is full of doom, and you're staring at your portfolio because the Dow just lost 2,000 points on a Monday, another 2,300 points on Thursday, and then another 3,000 points the following Monday. Your heart's pounding and your brain screaming, get out now. Save what you can. Sound familiar, right? And trust me, I've been there. And let me tell you, panic selling during a downturn is like jumping off a roller coaster mid-loop. Is going to hurt. And I can't tell you how many people sold out their investments in their retirement accounts in 2020 and never went back into the market. And guess how much they missed out on the gains just in 2020? The Dow Jones Industrial Average ended up finishing with a positive 7.25% return. The S&P 500 finished the year with a 16% return. And here's the thing about market downturns. They're scary. For some, they can even be traumatic. And seeing your portfolio bleed red is a gut punch. But what's even scarier is what happens if you get into the panic. If you just missed the top 5 days of market recovery since 1988, your long-term gains would have dropped by a staggering 37%. And let that sink in. 5 days, that's all it takes to turn a winning strategy into a mediocre one. And timing the market isn't just hard, it's almost impossible. So Warren Buffett, one of the world's greatest investors, does not panic. When markets tank, he doesn't hit the eject button. He doubles down. Why? Because he understands the market's long-term trajectory is upward. And Buffett famously said, be fearful when others are greedy, and greedy when others are fearful. Translation: when everyone else is running for the hills, he's buying at a discount. So imagine the people who bought more when the market tanked by 5, 10, or even 20% in 2020 and 2022. How about the Great Recession of 2008 when the S&P 500 finished the year with a 38% loss? So what should you do instead of panic selling? First, have a plan. A well thought out investment strategy is your financial safety net. It's what keeps you grounded when the market goes haywire. And build a diversified portfolio. Spread your investments across different asset classes, so you're not overly exposed to one or any single one. And diversification doesn't eliminate risk, but it smooths out the bumps so that no single downturn can knock you out. Second, stick to your plan. This is where the real test comes in. A great investor always comes out from a tough time in the market. When things get tough, your instincts will scream at you to sell. Resist the urge. Instead, remind yourself that the market is like a roller coaster ride. There are ups are always slow, and then there could go really fast. But the ride doesn't end in the middle. You have to stay on to reach the finish line. Third, stop obsessing over your portfolio. Seriously, it does not need hourly check-ins like your Instagram feed. Check your investments too often can heighten your anxiety and make you more likely to make impulsive decisions. Trust the process that you created, and it works best when you leave it alone. At the end of the day, downturns are a natural part of the market cycle. They're not a signal to panic sell. They're a reminder to stay disciplined. So the next time the market takes a nosedive, take a deep breath and turn off the news and stick to your plan. And I have several free resources like the compound interest calculator that you can download for absolutely free by visiting firestitcher.com/resources. Now let's talk about risk. It's like salt, too little, and your portfolio is too bland. Too much, and you're choking on volatility. And you need just the right amount to bring out the best flavor. I'm going to give you an extreme example. Back in 2021, people made the classic mistake of going all in on GameStop. And this meme stock reached a peak of $483 per share and plummeted to around $40 to $50 per share over the next few weeks. It was one of those once in a lifetime opportunities where everyone was hyping up on Reddit. But when the market cooled down, a lot of people lost their money when they went all in at an all-time high. You will lose money as soon as you throw away the basic fundamentals of investing. You're not supposed to gamble away your money on a single stock based on hype. Now, here's the thing about risk. Being too cautious can be just as harmful as being too aggressive. If you're overly conservative, you might not generate enough growth to meet your financial goals or even to outpace inflation. We know for a fact that inflation is the silent killer of wealth. So let's say inflation is running at 3% a year, but your savings or investments are only growing at 2% annually. Well, then congratulations, you're actually losing money. It's like trying to fill a bucket with a hole in the bottom. But going too far in the other direction, like taking on way too much risk, isn't any better. One market downturn or one big swing in volatility, and you could lose a substantial chunk of your portfolio. Worse, the emotional toll of those losses could tempt you into bailing out at the worst possible time and locking in your losses and ruining your financial plan. So how do you strike the right balance? Well, it starts with diversification. And think of your portfolio like a well-prepared buffet. You want a mix of everything: stocks for growth, bonds for stability, and a variety of assets for some extra flavor. When you diversify, you're spreading your risk across different types of investments, which means that when one part of your portfolio takes a hit, other areas can help soften the blow. For example, let's say you have a mix of tech stocks, defense, and aerospace stocks in your portfolio. If tech stocks plummet like they did in 2022, you won't feel the full impact because your defense stocks might still be stable and your real estate investments could be holding their value. Diversification doesn't mean you'll never lose money. It just means you won't lose all your money at once. It's like having airbags in your car. They won't prevent a crash, but they can save you from a lot of damage. Another thing to keep in mind is that your risk tolerance is not fixed. It changes as you move through different stages of life. What feels right when you're in your 20s and just starting out might not work for you in your 50s when you're getting closer to your retirement age. That's why it's so important to reassess your portfolio once a quarter or once a year and make adjustments as necessary. Your investments should grow and evolve with you, just like your goals do. So, what's the key takeaway? Risk isn't something to avoid, it's something to manage. You need just enough to keep your portfolio growing, but not so much that you're losing sleep over every market hiccup. Diversify your investments, stay disciplined, and revisit your strategy as your life and goals change. And remember, even if you've made mistakes in the past, there's always time to adjust and get back on track. After all, you want your financial story to be a comeback, collapse. And speaking of collapse, mistake number 3 is over concentration in individual stocks in your brokerage account. Look, while I am a huge fan of index funds, I do keep about 10% of my total portfolio in individual stocks because I read their balance sheets, income statements, and business fundamentals and listen to their earnings calls every quarter. I'm going to use the tech sector as an example again from 2022. My tech stocks crashed hard in 2022 and it was absolutely brutal. It was a reality check for me. And every investor that even FANG stocks can crash multi-digit percentage points. And FANG stands for Facebook, Apple, Amazon, Netflix, and Google, but we now call it the Magnificent Seven, which now includes Microsoft, Nvidia, and Tesla. So what I failed to do was properly reallocate my individual stocks after they went off from 2018 to 2021. These individual stocks I own had a 40, 50, and even 200% return over the past 3 years. My mindset was, what if they can grow a little more? A lot of people fall into that trap of, what if my individual stocks can grow another 30%? I don't want to miss it out, right? And here's the thing. Asset allocation isn't something you just do once and then forget about. It requires ongoing attention, like a houseplant. You can't just water it once and expect it to thrive. And over time, your portfolio starts to drift, often in ways you don't even notice. And when some of my individual stocks went up by 100% return, 200% return, I should have implemented my strategic allocation by keeping my individual stocks no more than 10% of my portfolio. And when the market crashes, that's when trouble sneaks in, like it happened in 2022. Those subtle changes might seem harmless in the short term, but they can leave you dangerously exposed when market conditions change. Just like what happened to my tech stocks in 2022. Even the pros on Wall Street or on CNBC were not immune to this kind of mistake. Did I buy more shares when Meta crashed to $90 a share? Absolutely. But the point of this video segment is that you should always watch how many individual stocks you own, if any, and strategically reallocate if it ends up beating your index funds by 2x, 3x, or 10x. They happen. Just like the Nvidia stock, when it blew up in 2024, it made a significant number of former Nvidia employees millionaires and multimillionaires because of the company's massive surge in stock price. And do you think they're going to keep 60 or 70% of their retirement portfolio in a single stock like Nvidia? I doubt it, because Nvidia already went through a 17% loss in a single day just last week when DeepSeek AI became a big deal. You just never know when these stocks could crash. This is why rebalancing is so critical. Maybe your investments have drifted, or maybe you've become overly reliant on one individual stock. Without regular check-ins, you might not even realize how vulnerable you've become until it's too late. Think of it like maintaining a garden. You won't let weeds overrun your roses, right? The same logic applies to your investments. Rebalancing is like pulling weeds to keep your garden or portfolio in this scenario healthy and thriving. It might even feel tedious at first, but it's worth the effort. And mistake number 4 is overpaying your taxes with your investments. Now, let me ask you this. What would you do if you got hit with an unexpected $3,000 tax bill because you sold out your investments with a short-term capital gain? Here's the main problem. People end up selling their investments without even thinking about the tax implications. A total rookie mistake, and I've done this too. And believe me, if there's one thing I learned from that experience, it's this. Taxes have a way of sneaking up on you when you're not paying attention. Here's the thing. Taxes are like mosquitoes at a summer barbecue. They're annoying, they're unavoidable, and they can totally ruin your day if you're not prepared. Most people don't even realize how much money they're losing to taxes until it's too late. And remember, many mutual funds and ETFs will distribute capital gains and dividend payments, including index funds. And picture this, you don't sell any shares, yet somehow you end up with a surprise tax bill because of these distributions. It's like stepping on a Lego barefoot, unexpected, painful, and it makes you wish you'd been more careful. Every month, I encourage you to log into your taxable brokerage account and click on transactions. And I'm showing you the Schwab version right now, but every brokerage account like Vanguard, Fidelity, and others has this function. And once you click on it, you want to make sure to filter your transaction types by dividends and capital gains. This page will tell you how much your investments paid you in dividends or capital gains distributions every month, every quarter, or every year. Are they qualified dividends or non-qualified dividends? Are they long-term capital gains or short-term capital gains? Because they can make a difference in how much you're going to pay in taxes in the following year. But keep in mind that you only pay dividend and capital gains taxes on your brokerage account and not your IRAs, 401ks, or HSAs, because they can grow either tax-free or tax-deferred. And that's why I always recommend prioritizing your retirement accounts, like your 401k, Roth IRA, and HSA, in your financial independence journey. If you're getting an employer match in your 401k, always contribute to your 401k first, but only up to your employer match, because you should never leave free money on the table. Then you should max out your HSA and Roth IRA contributions because they will grow tax-free. You do not owe any taxes on the 401k, HSA, or capital gains or dividends annually. If you cannot remember what should be your priority, just remember that your employer match will always be the number one priority because you should never leave free money on the table. I already said that twice. And followed by your HSA because it reduces your taxable income with tax-free growth, and followed by your Roth IRA because it will grow tax-free and you can take distributions tax-free when you turn 59 and a half. You can use your HSA for any non-medical expenses in the year you turn 65 years old. So do I invest in my taxable brokerage account? Absolutely, but only after I max out my 401k, Roth IRA, and HSA, because the amount of taxes I can save beats what I gain in my taxable brokerage account. But also keep in mind that there are unique tax advantages only available in the taxable brokerage account, like tax loss harvesting. If I sell a stock with a $10,000 profit, I can maybe sell a stock with a $10,000 loss to offset the $10,000 capital gain. At the end of the day, it's not just about how much money you make, it's about how much you get to keep. With a little planning and some smart tax strategies, you can keep more of your money working for you. And mistake number 5 is not hiring a financial expert in crucial moments. Like many of you, I'm a DIY investor. I know what you're thinking. Why pay someone to do what I can handle myself? That was my line for several years until my net worth significantly increased and my tax situation became increasingly complicated. And I realized that having someone else look at my financial situation can help me identify what I don't see on a daily basis. I consider myself pretty smart with money, but I still hire professional help to look over my taxes and investments as a second set of eyes. I talk to them to make sure I don't have a blind spot in my portfolio. But when you hire someone, make sure it's a fiduciary advisor who puts you above their interest, meaning they will put your needs above their wants. When I hire my CPA for my business, I made sure that he was going to put my interest above his. When I hired my estate attorney to create an estate plan for me and my family, I made sure that he was going to put my interest above his. And I also made sure that they had a great reputation in the local area. If you believe that seeking help is only for those who fail or are failing, think again. Do you ever ask yourself if you're doing the right thing with your investing, saving, retirement planning, or tax strategy? You may need an expert to take a look at what you're doing to ironclad your fire strategy. And what most Americans actually need is an accountability partner. They're your financial counselor who stops you from doing dumb things like putting your life savings into the next meme stock or meme coin. If you need a second set of eyes on your financial situation, you can schedule a 60-minute consultation with me by visiting firesession.com/consultation to allow me to become your accountability partner. That's what we're all looking for. Is someone to keep you accountable. Is your money going to the right place? Are you prioritizing the right investment account based on your current financial situation? I know there are many names and designations in the financial industry. What matters the most is that you find someone trustworthy or someone you can rely on, a sounding board to keep you focused and disciplined. And I'm sure you want to be more confident about your financial future. I can't tell you how many people have told me that they wish they had talked to someone at the beginning or sooner. Even the most cautious investors can benefit from professional advice, whether it's a full-time advisor or just periodic check-ins. Having an expert in your corner makes all the difference in the world. And I know I sound like I'm trying to start a commercial or something, but I'm just telling you from my experience. It's not just about managing your money. It's about creating a plan that grows and adapts with you, no matter what the market throws your way. Now, let me ask you this. Which of these mistakes have you made? And be honest, drop a comment below. And remember, investing is not about being perfect. It's about being consistent, being patient, learning from your mistakes, and making smarter decisions. And this has been another beast of a video, and I hope you got a lot out of it.